Good afternoon, everyone. Welcome to our investor webinar, where we are going to discuss the full year results for 2019. With me, we have some of our leadership team members, Vice President, Senior Vice President, Corporate Banking, Bonek Pera, Vice President, Treasury, Niran Awata, then Assistant Vice President, Strategy, Shankar, then we have Vice President, Finance, Suendeni Mutikumarana, Senior Vice President, Retail Banking, Sanjay Pera, and Vice President, Business Banking and SME, Indika Ranavira. I will take you through the presentation, and as usual, we'll leave room for question and answers at the end of the presentation. So we'll move on to the business overview. 2019 is a significant year for NDB, where we celebrated 40 years of banking in Sri Lanka, having started as a development bank in 1979, and we moved into a fully fledged commercial banking entity. Apart from that, human capital wise, we have a very well diversified staff, of which 40% female employees, 2,900 staff strength. So last year we had about 400 new staff added, mainly on the front line. About 35% of the senior management positions are filled by females, and we are the first and only entity in Sri Lanka to be EDGE certified, confirming our equality for gender equality practices by NDB. In terms of key strengths, bank is offering all universal banking products. So is the group. We have the several subsidiaries involved in capital market cluster, NDB Capital, NDB Investment Banking on structuring debts and capital, NDB Wealth Management, and also the stockbroking arm. And also the digitalized solutions that we have started offering. And last year we recorded about 71% of all our banking transactions performed through digital channels. In terms of our physical presence, as of December, we had 112 branches. We added our latest branch, Ikadua, opened in January. So now we have 113 branches, 100 ATMs, of which about offsite 20 ATMs, 54 recycling machines, and also 80 plus branches banking arrangements where through Bank Due we reach customers. We also opened 2 NDB NEOS digital branches last year, one in January, and then last quarter the other one in Fort and the other one in Shangri-La, Colombo. And also we also relaunched our highly popular NDB mobile app to the latter part of the year, which is doing very well. In terms of recognitions, international and local, we received close to 50 awards last year. Among them, some of the key awards as well. So, Global Finance Magazine of USA recognized us as the world's best consumer digital bank for Sri Lanka. That was one of the key awards on the digital front. The Asia Money magazine awarded us as the best domestic bank in Sri Lanka, and also Global Banking and Finance, again, as the best financial services conglomerate, and also they awarded us with the best SME bank and best project finance bank. And then Euromoney for the 8th consecutive year awarded the NDB Investment Banking as the best investment bank in Sri Lanka. Of course, the governance and the management are very strong at NDB. We have a very competent and diversified board of directors with an independent chairman, experienced and dynamic top management, very well experienced, and also the commitment to the highest standard of ethics. So that's a brief overview about the bank and the group. Now I'm moving on to the financial performance. I think all in all, 2019, despite being a very challenging year, where the industry also went through a lot of stresses, NDB has done exceptionally well, I would say, compared to the industry, how it has performed. Gross income level year on year, we had 16% growth to cross 59 billion LKR. Interest income, 20% growth. These, I think, in the net fee and commission income, again, 25% growth to reach 3.9 billion. So all in all, the pre-tax core banking profit, we had 8% growth year on year to 9.6 billion. The total operating expenses, there was 11% growth to 9.4 billion. And as a result, the overall profit before tax figure was 6% growth. And we've crossed 10 billion. This is the first time that NDB has crossed 10 billion mark out of the operating banking operations. And when you compare the industry numbers, I think this is more significant. Industry profit before tax was 4.3% negative. In that scenario, 6% growth in profit before tax, I would say, is quite good. Profit after tax, of course, compared to last year, there's a 8% drop in profit after tax, mainly due to introduction of new taxes, specifically the debt service levy, where we had 1 billion alone was the tax paid on debt service levy. So as a result, profit after tax crossed 1.1 billion, which is a negative growth of 8%. In terms of balance sheet, there are significant achievements in terms of growth. All in all, 12% growth in total assets to cross 530 billion. 2019 marked NDB crossing the 500 billion asset base. And at the end of the year, we crossed 530 billion. Deposits, we had 17% growth, crossing 400 billion. We ended with 405 billion deposits. And on the gross loans, again, 16% growth, 409 billion was the final figure. So I think all in all, under reduced growth activity that we saw with low overall GDP and industry also the growth deteriorating, NDB has done well to have quite a sizable growth in our asset book and also the deposit base. Now we are moving on to more detailed assessment of the above summary. If you go into the fund and non-fund based income analysts, revenue analysts, interest income, we had 20% growth from 44 billion to 53 billion. And interest expenses, again, 20% growth from 29 billion to 35. So as a result, the net interest income is again 20% growth of from 14.8 billion to 17.7. You would have seen that the asset growth or the lending growth rate was 16%, as I mentioned earlier. So with a 16% growth in asset book, delivering a 20% growth in NIM shows that naturally the NIMs have improved and then the efficiency has improved. Net fee and commission income, again 25% growth. In terms of quantum, 773 million growth coming from fee and commission income. That's an area that I think I was updating in the industry forum as well. We have been concentrating on growing the fee-based income, and that is quite a good 25% growth. Trading side, of course, there's a drop of trading gains from 1.2 billion to 990 million. Again, on the net gains from derecognition of financial assets, there's a growth of from 384 million to 716, 87% growth. Equity income, this is basically the dividend and the equity income where there is a drop from 612 to 448. The other operating income, there's a significant drop from 1.4 billion to a negative 127. This is mainly due to the exchange revaluation gains last year due to the 2018 due to the strong depreciation of Sri Lankan rupee. There was an exchange gain on the foreign reserves, and in 2019 Sri Lankan rupee appreciated compared to the depreciation trend that we had seen. So as a result, there was a small loss of 127 million. But when you compare 2018 and 19, you see quite a big variance, more than 1 billion. So overall, the non-fund based income, there's 12% drop from 6.7 billion to 5.9, mainly due to these exchange losses or exchange gains that we recorded 2018. That's the main reason for that drop. So the key drivers of this growth are naturally the asset book, the growth in asset books, and also the trust on improving our fee-based income, and also the trust on the digital financial services, where we made quite a strong headway through the NEOS app and also through various other digital means like the cash recycling machines, the bank PU arrangements, etc. Moving on to the operating expenses side, again, overall 11% increase in operating expenses from 8.4 billion to 9.4 billion, nearly 1 billion increase. There again, the personal expenses, we had roughly about 600 million increase, or 12% increase in personal expenses, mainly driven by additional staff base increased by about 400 in 2019, mainly on the frontline and selling staff. Apart from that, the salary annual increments and all. And then the other expenses, there's 10% increase from 3.5 to 3.9. This is mainly on the depreciation and other expenses on digital and physical infrastructure development, including the opening of 4 new branches, of which about 2 digital branches. Naturally, the cost of the digital branch is higher than normal branch, plus opening of about 10 leasing centers. All those have contributed to this cost escalation. But these are good investments where returns we are going to realize over the years, and even last year itself we had some substantial contribution coming from these capital investments. In terms of taxation, you would note that the effective tax of the bank has gone up from 42% in 2018 to 49%, mainly driven by debt repayment levy, which is a sizable increase. Last year, 2018, only the last quarter, this was introduced and we incurred about 230 million. The whole of 2019, this was 1 billion, so that's a sizable jump there. Plus also the VAT on financial services. Those are the key drivers of effective tax rate going up from 42 to 49. So in that scenario, the recent announcements on tax relief are going to positively help the bank and the industry. The debt service levy has been taken out from 1st of January, and also the VAT reduction and even the effective tax reduction that have been announced on the corporate tax from 28% to 24%. These would help us to improve on the ultimate bottom line, because this is something the industry was raising many a times with the decision makers, because this is one of the highest tax industry, and good to see that effective tax rates have come down effective January. And that hopefully would get translated into more contribution towards economic development. We are looking forward to plow back those funds saved back to the economy through capital retention and providing more economic support. Moving on to the balance sheet, quite a good story relatively compared to the market. I have the industry numbers as well to compare. Total assets, we had a 57 billion quantum growth. In terms of percentage, 12% year-on-year growth from 473 billion to 530. So as I mentioned, this is the year we crossed 500 billion, and this was one of the benchmark earlier identified as a systemically important bank. But in December, Central Bank coming up with, apart from the 500 billion asset target, interconnectedness, and then a couple of other measures like complexity. So as a result, there's only 4 domestic systemically important banks, and as a result, there was no pressure on capital to raise capital. So compared to the industry, the total industry asset growth was 6%, and then NDB had 12% growth, so double the industry asset growth. If you look at the loan book, again, 56 billion in quantum, 16% in terms of year-on-year growth from 353 billion to 409 billion. Again, first time the NDB's total loan book crossed 400 billion. So industry growth rate was 5.3. So we had 16% growth, so which means 3 times the industry growth rate that we recorded in terms of loans. And in terms of deposits, again, a 57 billion quantum growth. So deposit growth quantum-wise is slightly higher than the loan book, from 348 billion to 405. Again, the first time that bank has crossed 400 billion in deposits. So again, 17% growth. Industry grew by 8.3%. So again, double the industry growth that we had in terms of deposits. So we had doubled compared to the industry, the deposit side. We have tripled the growth in advances compared to industry growth. And total asset growth, we are doubled from 6% industry growth to a 12% growth. So that's actually would indicate something about the market share. I think the market share also have gone up. Now I think we have crossed 5% in terms of assets in the market share, loan assets. So that is a sizable market share growth that we had seen. Moving on to the impairment analysis. So the individual impairments remains somewhere around 2.8 billion. Previous year also it was around 2.8 billion. But however, the collective impairment has gone up from 770 billion to 1.1 billion. NPL ratio was 4.7. Of course, that increased from 2.9% last year to 4.77. But among the industry, I think industry NPL also stands around 4.7. So we are somewhere similar to the industry, but when you compare that with mid-sized banks where the NPL ratio is around 5%, slightly better than that. But of course, that's an area, stress area, all the banks have seen, and we have made a lot of effort to improve on the underwriting standards as well as collection standards, and have strengthened a lot in this area. So we are expecting some changes to this level as we move along. So all in all, the provisions, the impairment provision from last year to this year, 16% growth in impairment from 3.5 billion to 4.1 billion. So 16% growth in impairment corresponds well with the 16% growth in loan book, because the significant growth is also on the collective impairment side. Other thing is the provision quality, the adequacy of the provision quality. We have now 3.1% of the gross loan portfolio. We have impairments totaling 3.1%. Compared to last year, this was 2.9%. So there again, despite growing our loan book, we have been conservatively improving the provision cover, the impairments. So from 2.9% impairment cover to 3.1%, there's improvement as well. Further details on the loan book. Currency-wise, we have made some good headway in improving the currency mix from in 2018 it was 75% foreign rupees to 25% foreign currency. I think this is some one of the strategic objectives in shifting towards more LKR-based loan book, and we ended up with 79% in LKR and 21% in foreign currency. If you look at the sectorial composition of the loan book, again, you would see quite a well-balanced pie chart, where the consumption sector and the manufacturing have a higher percentage, but still it's quite a well-balanced exposure, which shows the dynamism in the loan portfolio. The key funding sources, the balance sheet was actually supported by an increase in deposits. We saw the quantum increase in deposits, and also funds through the debentures that we issued the first quarter of 2019. So even the composition of our deposit base, you would see the current accounts about 2 billion growth, and also savings 2 billion growth. So all in all, CASA, we had about 4.3 billion growth in CASA. Time deposit had the highest growth, 53 billion. So from 348 billion to 405 billion. Then we ended up with a CASA ratio of almost 20% in 2019. In terms of debentures, we issued actually raised 5.5 billion as Tier 2 capital subordinated, unsecured subordinated debentures with a 5-year tenor that helped us to improve on our Tier 2 capital levels. So this is how we funded our book. Moving on to the capital ratios. Despite the minimum capital requirement of 7%, Common Tier 1 ratio stands at 9.2%, and Tier 2 at 13.4 compared to a minimum of 12.5. So nearly 100 basis point buffer on the Tier 2 level capital requirement. If you look at the group level capital, this goes up to 14.2. And then the liquidity ratios, we are very much within quite a good liquidity ratio, and so is the net stable funding ratio. So overall, the healthy capital and liquidity position. Moving on to the investor ratios, of course, the share price, it's closed at 100 rupees. Previously, it was 106.8. So whatever these good improvements are unfortunately not reflected on the share price. So that is, I would say, for the market, that's an opportunity. Earnings per share from 28 to 23 rupees down because we enhanced the capital as well through a scrip dividend that was paid in 2019. Return on equity, 17 from 17.4 came down to 13.7, again mainly due to the dilution of the share capital base. But compared to the industry ROE of 10.5%, we are 13.7, so above the industry ROE. ROA level, again 2% pre-tax ROA, and book value improved from 166 rupees to 178, and price earning times from 3.75 to 4.3. So price to book value now at 0.56, which was 0.64 times last year. Now this is something I would say the opportunity for the right investors, because the share is trading almost 50% of the book value. We announced our first and final dividend yesterday, a 7 rupee per share dividend, of which 2 rupees as cash dividend and 5 rupees scrip dividend. And we have continued to maintain the dividend payout ratio of 30%, which is the ratio that we have been maintaining over the last few years. So basically, that covers the prepared presentation for this webinar. Now we are open for questions, so you can raise the question, and then I will read the question and then come up with the answers, and that's where my fellow leadership team members would also chip in wherever that is appropriate. Now the question is, the average ticket size of new loan given during 2019 same as previous year, or the loan given in 2019 only among few clients with higher ticket size? Does this bring the concentration risk? That's a question, but I don't think there's no change to the average loan size. It's a portfolio growth from all sectors coming in. In fact, on the retail side, the growth is more, so which means in the retail side, actually that has helped diversify the loan book because the growth coming from retail and project finance side are bigger. But of course, it's not ticket size. Actually, ticket size would have been lower, but more volumes. I mean, these were the process improvements that we made 2019 had helped us as well. Even in the increase of staff, we didn't have no significant increase in support functions, the processing function and all. I think with the efficiencies that we brought in terms of process efficiencies and also the robotic process automation, we managed to improve our efficiencies, and as a result, we managed to process many applications. So there's no concentration risk as such. There was a question. There are two components in loan book. One is construction and other construction and infrastructure. What's the difference? Anyway. And construction? Okay. There's no. Okay. So the infrastructure development is, which is about, so that's mainly on the project finance and the long-term loan exposure, whereas construction and infrastructure, mainly the working capital side of that. There's a question on the decline in fourth quarter 2019 is SLDB tax reversal. How much is that, please? Yeah, it's roughly around 350 million in the case of NDB, where the last minute reversal of tax changes, that's what contributed. Mr. Capital needed given only. There is a question on when the capital given only 70 basis point tier 1 buffer as of now. I think we have done some assessment, and total capital ratios still, as I mentioned, close to 100 basis point gap is there. And tier 1 level, yes, 70 basis point at the moment. But it all depends on how we grow the book, how risk appetite, the risk-weighted asset side. Along with that, the profit generation, how much that you retain within us, and also these proposed tax reductions would also help to reduce the tax burden and retain profits to be improved. So as a result, I think we are quite comfortable with this level of cushion, and also the future tax savings that's going to help us improving the capital cushion as we move along. So I think we are comfortable with this cushion. What plans to increase CASA? There are several plans. I think some of those plans we don't want to elaborate more due to competitor reasons and all. But you would see that last year also CASA growth of 4.3 billion, mostly coming from the retail side. But there's very concentrated effort on bringing granular CASA, and that has helped to grow this. Sanjay, want to comment any?
Yeah, I think as CEO said, it is at granular level, complete focus on the small deposits and concentrated effort on the sales side. So that's what it is, and a few strategies implemented which have been successful. So we'll continue the same thing this year, sir.
There's a question on quarter to quarter credit quality metrics have improved. Gross NPL down from 4.77 down to 4.77 from 4.9% in third quarter. From which sector the improvements have come from, and looking ahead, do you expect a similar trend to continue? I think the recovery side that we strengthen our recovery side and also the collection side. So these recoveries came in from all sides. There's no particular sector as such who exceptionally contributed, as it came from all sides. So and also the preventive measures that we have taken to ensure that new flow of NPLs are stopped by proactively looking at the problematic accounts. The both combined efforts have helped us to improve on the NPL ratio. Going forward, the next question is about whether looking ahead, what do you expect? I think we can expect a similar trend with the stimulus that is offered to the economy. Of course, we need to look at it from the industry point of view. The low growth scenario, 2 years consecutively low growth. The money circulation was limited, and I think some of those getting corrected. The positive sentiments, the tax releases, and also some of the funds the Treasury is planning to release, especially to the construction sector, that should trickle down to the next level of economy. You'd expect some kind of a revival, so that hopefully that should help on the business improvement as well as recovery improvement. So we expect the ratio to improve as we move along. What is the composition of SME, retail, project finance, and corporate currently? And what's the optimal target the bank is trying to reach? And what challenges are NDB is facing when trying to reach that target? Yeah. I think we have been discussing this earlier webinars as well, that the retail and SME is an area that we are concentrating on growing, because NDB over the years have been traditionally very strong on project finance and corporate banking side. We have one of the very good portfolios in corporate banking. Strong project finance, that's where we have been expert for 40 years. The area that we moved into commercial bank is only about 15 years ago. So naturally, that's the area that there's a lot of potential and the growth opportunities are. So we were concentrating on more growth on retail and SME side. But last year, given the industry situations and all, we scaled down our SME growth because we were more concerned on the quality rather than quantity last year on the SME side. But certainly the retail side, we were quite aggressive, and quite a sizable growth came from retail. So as a result, the retail SME to corporate and project finance ratio also moved in favor of retail to SME in a higher percentage, and which is in line with our goals as well. That helps us to diversify our book more, improve on the margins, and also in terms of the risk-weighted assets, that also helps us to reduce the risk-weighted assets. So in all those areas, I think that has helped us. We have been managing it very carefully. Some may argue the retail sector may be a riskier sector, but I think our underwriting standards are good, our collection standards are good. So as a result, I think one of the best NPLs as well on the retail sector. So we have been doing a good job there. There's a question out of that SME exposure, what's the percentage of SME that have applied for moratorium and how much have been approved? Approving in the direction of the respective banks or in the discretion of central bank. So there are two questions. One is out of the SME portfolio, how much have applied for the moratorium? Other question is whether those approvals are within the jurisdiction of the bank or whether we need to decision of the central bank. I think that exposure-wise, it's not, I would say, compared to the total asset book, not a sizable exposure, roughly around 2% of the asset book, total asset book. And out of that, again, some customers have applied who are in the NPL category. So the performing category is around, I would say, 2% of the loan book. And on the NPL side, that helps a lot as well because these are customers who have not been approaching the bank, having gone into NPL. So there is a win-win situation where both non-performing customer for unfortunately the downturn in the economic reason coming to the bank and agreeing to work on a restructuring plan. Of course, from the bank side, we are giving them interest concession on the penal interest and also on the future interest. Of course, subject to servicing the restructured facility as per agreed terms. So I would say that it's a win-win arrangement where those who are reluctant to come to the bank now coming and approaching us. So we take it as a positive arrangement where we can also help these clients. Whatever the new facilities that we are going to grant, subject to our credit evaluation, if we grant them, Central Bank has come up with a credit guarantee scheme. So that also helps to support this credit so that the risk impact to the bank are managed due to the credit guarantee scheme arrangement from the Central Bank. In terms of performing loans, it's a matter of extending the payments on the working capital facilities. But if it is a good credit, we are willing to give in fresh funds as well. So most of the requests that have come from are bankable, genuine credits, so that we are looking at them, how we can support them. The entire branch network have been advised to receive these applications in a positive way rather than saying no to them, because these are the clients and NDB is there to help them. We are not the bank who take up the umbrella when the customer is raining. We would like to support these customers, bankable customers. Certainly, we would go extra mile to support them. But willful defaulters, certainly we take the hard stand. So all in all, I think not a big impact to the NDB's portfolio. How much of the total loan book is comprised of SME? I have answered that question. And again, the question on the moratorium, so that again I have answered. Yeah, this one. Decline in fourth quarter ETR effective tax rate is due to SLD with tax reversal. How much is that? So I gave the number, it is 350 million. Yes, it contributed in the last quarter. Now there's a question on what is the expected reduction in effective tax rate in 2020 through the tax cuts. So whether you want to comment?
So the regulatory effective tax rate should be around 43%, which will consist of corporate tax rate and financial services VAT.
So it was last year how much? 57?
Yeah, in comparison to 57% in the year 2019. So with the removal of DRL and removal of NBT and the reduction in the corporate tax rate from 28 to 24%, we expect the effective tax rate to be around 43-44%.
Okay, there's a question on going forward with IFRS 9 impairment calculations. All the banks will go after high credit quality borrowers. With the CASA of around 20%, what would be the strategy for NDB to maintain or improve NIM? Good question. And this is where we are also working on in terms of improving the CASA ratio and also improving cost of funds. So I don't think when you look at improving cost of funds, you should only be limited to CASA. Now, out of CASA, the savings accounts, now with the interest rates also coming down, the difference between SA and FD is also that's trending down. It's no longer a big variance. Earlier, the FDs are going around 15%, interest rates for the savings accounts were around 3.5%. So there was a big gap. Now that gap has come down. So I would, yes, CASA is one side, but apart from CASA, we need to look at how we can bring our cost of funds down. So we have various means of bringing cost of funds. So that is where we are concentrating to bring our cost of funds down. And we have seen our cost of funds coming down. If you look at our CASA ratio, end of the year is 20%. Beginning of the year, it was around 21%. So CASA ratio remains more or less the same. But we would have seen the NIM improving from 3.4 to 3.6%. So that's not only the function of CASA, but there are other ways of improving the cost of funds. And also repricing your book appropriately at the right time. So we have a very active ALCO with treasuries involvement and then all the business lines very actively take part. We foresee what's going to happen in the future. Very good discussions happening on ALCO. So to reprice the book appropriately, so that has helped to improve our NIM. And also shift of exposure to more retail and the volume growth there also has helped us to improve on the NIM. And also the shift of our currency from 25% foreign currency to 21% foreign currency. All those have helped. So it's not only a factor of CASA. There's a question on NPL ratios decreased in absolute terms. It's only slightly increased for the quarter, but the impairment charge has still increased quarter and quarter. It is an indication that there is no increase in the stage 3 loans, while there are still movements towards stage 2 loans. These won't go as NPLs, mostly due to less than 90 days. Yeah, so yeah, partly correct. Yes, the stage 3 level, there was no large increase. Have you disclosed the stage 3 numbers? Yes.
Portfolio number.
Not yet. So yeah, we are yet to disclose that, but the internal numbers are there's an improvement from 2018 to 2019. When we publish our annual report, the bucket-wise numbers would get disclosed. However, stage 3 level, there's an improvement. Other one is the impairment increase is mainly due to the collective side. I think I explained that in the slide where collective impairments sizable increase compared to last year. One was the volume growth, 57% volume growth in loans and advances. So that, and then especially during the fourth quarter, the volume growth was high. So those are the reasons for the impairment growth mainly on the collective side. There's a question whether NDB will raise more capital at Tier 1. Again, I think I answered that. There's sufficient cushion in terms of capital ratios and also the tax savings that would hopefully improve the retained profits. So not for the moment, but we might come with on the Tier 2 level as and when there are opportunities, we will be coming to the market on the Tier 2 level. Where do you see interest rates heading? I leave it to Niran to answer. He has the crystal ball by the way. Another question is, have you received a moratorium request from garment manufacturers due to COVID-19, as some banks have indicated? So far, we have not received any such requests from garment sector exposures. Niran, would you like to take that question on interest rates?
So on the interest rates, of course, we feel that the rates will remain flat at the current levels, given the fact that we have not seen a significant improvement in the credit demand. So probably we might see these rates remaining at these current levels.
As a question on, could you kindly let us know overall average duration of the loans and deposits of NDB? Niran, would you like to take, the liquidity-wise, the maturity buckets and all, we are quite okay. You want to,
It's basically very much matched between the deposits and the liabilities. We have built up our retail base significantly over the last few years. So with the deposit mobilization and also some of the long-term funds we have raised in 2018 and 19, one is to some of the DFIs, and the next one is on the debentures. So because of that, mainly right now is very much hedged on both sides.
There's a question on, will this aggressive loan book growth in 2019 lead to higher NPLs as the defaults will add in another 12 months down the line? I don't think that is applicable here, because our underwriting standards are quite good. This is an area that we strengthened a lot. Other thing is, as I mentioned, most of the growth also came from retail side, housing loans, and also on the project finance side, where these are well-tested, good borrowers, where credit matrices are quite strong. So, an area that we have been strengthening was underwriting standard. Apart from that, the credit monitoring standards as well. Now, for example, the credit underwriting, we introduced a independent financial analysis unit within corporate banking and project finance itself to give that expertise and credit assessment for these larger exposures. So this is one example, but similarly on the regional level, strengthen the credit approval mechanism, and so is the personal credit side. So the underwriting standards are high, so very unlikely that we would see. Other one is the exposure to the personal credit side with the tax reductions on the personal income level. Again, the funds available for servicing of debt and all also is expected to improve. So it's unlikely that that would have an adverse impact on the NPL ratio. Loan growth expectation for 2020 and what segments are expected to drive the growth. I think we have prepared a budget that we are expecting somewhere around 20% growth in balance sheet. So similar to last year. Last year, in a challenging year, we delivered 16%. So in a year where things are expected to improve, 20% growth in advances, that is something achievable. We have the mechanism and also the processors, the staff strength and all to achieve that. So we are looking at somewhere around that. Niran, this question is to you. The exchange rate is expected to depreciate whilst the yield curve is expected to go up towards the second half of the year. Do you see a major negative impact arising from the yield curve pickup? Obviously, there will be a gain on the mark-to-market on exchange rates.
Yes, the second question is correct. Basically, what will happen to all the banks, for that matter, industry-wide, they will benefit from a depreciation. But at the same time, on the interest rate side, as I earlier said, unless otherwise there is a significant increase in the credit demand, I don't foresee a big interest rate hike, even though the liquidity will be an issue. So they have to bring in the liquidity in the market. So, but we have got some guidance even from the policy statement that they will provide enough liquidity to the market. So because of that, we don't foresee a reversal in the yield curve as soon as the second quarter or in the second half. Probably we might see something towards the end of the year.
This is also to you, Niran. Despite low interest rate environment, private sector credit growth is not picking up as expected. Do you see rates coming down further or maintained at current level?
Immediately, we feel that they will keep it at the current levels, because now it's just the last month that they cut the rates. So they will feel the pulse, and also, as I said earlier, the liquidity will be very key. Because also there's a vote of accounts going through today to increase the borrowing component through the bills and bonds. So that might be additional pressure into the market, but at the same time, we feel that probably after the elections, they might go to the market to borrow some overseas dollars and all that, and also some other means of funding the account. So we feel that there may not be an immediate rate cut as such.
There's a question on individual impairments have come down. What drove this decline? I think again, this is assessment of cash flows, and it's based on case specific and also the level of security that we have. So that was the key driver for individual impairment, and this has been assessed and later on verified by the external auditors as well. So that's mainly the developments in the cash flow assessment. And for that matter, even some of the construction industry exposures, how NDB has handled compared to maybe some of the other banks is that we have been very specific on project-specific exposures. So it's linked to the project-specific cash flows, exposure-wise also. We don't have any general lines as such for even the construction sector. So that has also helped us to have a very close monitoring and ring-fence each project against whatever the other issues they face in other projects. So that has helped to improve on the individual impairment side. There's a question on what is the bank's exposure to the tourism sector moratorium. I think this question came in last webinar as well. We don't have a sizable exposure as such. I think if you look at our industry pie chart, the total exposure to tourism is somewhere around 2%. And of that 2%, quite a sizable exposure into overseas as well, especially Maldives and all. So the local exposure is around 1%, but there again, moratorium requests we didn't receive from all customers, so it's very manageable, lower than 1% exposure.
70%.
As the tourism sector moratorium given in April last year extended till end of 2020, I think the moratorium ends in April, but in case a customer requests, we are willing to reconsider that deadline. Along with the SME moratorium, there was requests from Central Bank as well to consider enhancing them up to end of December. So on case-by-case basis, if it makes sense, we would support that extension of moratorium up to December. There's a question, how often a stage 3 loan can move to stage 2? What are the requirements? How many installments does a stage 3 guy needs to continuously pay before moving back to a better stage? And there are some learning questions coming up as well here. You want to come in?
Yeah, I think credit quality has to improve and it has to come out of NPL status. Stage 3 reflects the NPLs of a bank, or if there is if loans are rescheduled more than twice. So mostly if the facility is performing after some time, then it moves from NPL and then we can move it from stage 3.
There is a central bank issued guideline on stage-wise categorization. And if you can get hold of that, you would get more insights about how the staging-wise movements are taking place. There's a question, when do you think NDB could reach ROE equivalent to its cost of capital? I think, no, of course, last year we delivered ROE of 17%. This year, naturally, due to huge tax burden, ROE came down to 13.5%. But still, it's in line with the cost of capital, I think slightly above the cost of capital. We are above the cost of capital, so I think compared to the industry, I mentioned industry in ROE is about 10%. So in an industry where ROE is 10%, still 13% is, I think we are above the cost of capital. Okay, there's a good question on, probably Shankar can take this. NDB started using big data analytics in their credit evaluation. For instance, that's a good credit rated individual tend to get a loan at a lower rate or blanket rate will be applicable across the board for all. I think I'll partly answer, and then on the data analytics, Shankar can chip in, since question also talks about credit. As with credit, we do use big data as well for the credit evaluation, but the pricing is more on a risk-based pricing. And also we have the RORAC model, where risk-rated capital, the return on risk-weighted capital. So each business line has been given a particular minimum RORAC to achieve based on the risk-weighted assets. So that is how we price. So we ensure that the risks are appropriately priced. With regard to the data and the big data, Shankar, you want to share some progress?
Yeah, so we have been using data analytics for quite some time, and like CEO said, the various risk pricing models is fed by the data analytics, the output from the data analytics, and mostly we use it to identify cross-sell opportunities across customer groups and business segments.
These are the questions we have received so far. Are there any other questions? No other questions, right? Okay, so thank you very much for taking part in the webinar, and also thank you for those questions, some interesting ones as well. And I think all in all, we are done quite well. Unfortunately, the reflection on the price is the issue. which is unfortunately the market situation here in Sri Lanka. But good growth story, which will be continuing to grow on the same lines. We have done a lot to improve on the internal processes and the efficiencies. You would have seen the cost income ratios, 39% compared to the industry average of 46%. The efficiency wise and the profit per employees, all those metrics have performed quite well. So it's a good way to move on in 2020. Would like to update you all again in a similar webinar. And we will be having our press conference as well soon after the release of the annual report, most likely in early March on the results again. So thank you for being part of this investor relations activities and looking forward to more engagement as we move forward.